I'm Rileigh Armstrong, and today I'm going to be talking to you about what a mortgage is and how it works. So as you're excited about this new chapter of your life and you're ready to buy a house, you have to start thinking about how to take out a mortgage. And that can be stressful, so I'm here to relieve some of that and give you some steps. So you're going to go to the bank and you're going to need to take out the amount of money that you're unable to pay up front for the house. And then you will have to pay that back monthly with an interest rate that is decided by the bank. So you can pay that back 10 years, 15 years, or 30 years, and that's also determined by the bank. And if you're unable to make those payments monthly, then your house can be used as collateral and can be taken away. So as long as you're good on your payments, that will not happen and you don't have to worry about that. And there are 5 different types of mortgages that Anisa will talk about that you're able to decide with your bank for which one is right for you. And now on to Anisa.
Thanks, Rileigh. Okay, so today I'll be discussing the benefits and interest rates of the 5 types of mortgages Rileigh listed earlier. The first type of mortgage we have is the fixed rate mortgage. This has an average interest rate of 2 to 4%. This is a great option for people who like consistency over time. The second mortgage we have is adjustable rate mortgage. This has an average interest rate ranging from 1 to 6%. This is great for people who like to be flexible with their payments. The third option we have is the balloon mortgage. This has an interest rate of around 3%. This is great for people who plan to make more money in the future. The fourth loan we have is the Federal Housing Administration loan. This has an interest rate of around 2 to 2.5%. This is a great option for first-time homebuyers as it accepts lower incomes and credit scores. Lastly is the Veterans Affairs mortgage. This interest rate is around 2.5%. This is a great option for veterans as there's no required down payment or mortgage insurance. This is also a great option because there's no prepayment penalties, meaning you can pay off your loan faster. Now on to Emmanuel.
Hey, thanks Anisa. Today I will be talking about mortgages and which group of audience should know this and the reason why. Everyone wants to buy and own a home. For many, that's the American dream, and a mortgage is just one of the steps it takes to get there. Buying a house will likely be one of the few large purchases you make throughout your life, and mortgages help when you can't pay the home's full amount of money up front. This is where your mortgage loan comes into play and why people should know about mortgages. Therefore, our targeted audience would be for people who are 18 years old and older. Our audience should and need to know about this because they could use this knowledge later down the road in their life and know how to take out a mortgage when their time comes to buy a house in the near future. Thank you.
Getting a mortgage is not the easiest thing to do, but there are steps that you could take into consideration to make the whole process much easier. First things first, make sure to be financially prepared. Then you could find the lenders and the mortgages that are best suited for you. After that, you will get pre-approved and you could start applying until you get accepted. Once you get accepted, you can start the underwriting process and hopefully be closing in on a home soon. But it is not that simple. There are requirements that you have to meet just to be eligible. One of them is to have a 3% down payment at the start. Another is to be able to provide a PMI. A PMI is a private mortgage insurance. This is a monthly payment that could start off rates from 0.15% to 1.95%. Another thing that they look at is your credit score. Your credit score has to be at least at a 620. Anything better gets you better rates and a lower PMI payment. You need to be able to provide 2 years of work history showing your current job as well. 2 years of your business and personal tax returns. Another thing you have to be able to provide is your DTI. Your DTI is your debt to income ratio. You can find this by dividing your debt to your gross income, coming at whatever it comes out, the maximum has to be 45%. Another thing that they look at is your cash reserve. This shows them that in case of an emergency, you have the money to make the payments. Hopefully this helps you with your mortgages.
Thanks, Maria. So now that you know the different types of loans available and the requirements needed for these loans, it's time to take action. Just remember you'll need a credit score of at least 620 and a down payment of at least 3%. When choosing a loan, make sure to take into consideration your financial situation and lifestyle. More information about the application process about getting a mortgage can be found at your local bank or on the Investate PD website, which I have linked below. Thank you!